first rate cut in the books. Is Allied Properties ready to move back into profitability? Fasten your seatbelts, folks. This is going to be a good one. Allied Properties is a leading real estate investment trust in Canada. They specialize in owning and managing properties in urban office environments right across the country. They do love to buy distinctive buildings for their architecture or historical significance. They will often repurpose and modernize these spaces to make them much more attractive to potential tenants. They also have a commitment to sustainability and urban regeneration, often revitalizing underutilized urban areas into dynamic business districts. This approach not only preserves architectural heritage, but it also contributes to the economic and cultural vitality of the cities where they operate. During the pandemic, AP REIT had a serious challenge as widespread lockdowns and then the shift to remote work, well, it dramatically reduced the demand for office space. Many businesses downsized or terminated their leases as they adapted to new working models, leading to increased vacancies and decreased rental income. The share price, of course, did not react very well to this for sure. Moving into recovery, AP REIT began to adapt to the changing work environments. They focused on enhancing their properties to accommodate hybrid work models, emphasizing flexible and collaborative spaces. Their commitment to revitalizing urban areas and providing unique high-quality office environments has aided their recovery, gradually restoring tenant confidence and, of course, those occupancy rates. Without a doubt, as we move into a rate cut environment, they will also benefit from less servicing costs on their debt, which should also help bolster them into the recovery. Join today's conversation. Let me know in the comments if you hold any Allied Properties. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more, and another huge thank you for that click. For this deep dive, we will be using data from their latest quarterly report, which is for the quarter that ended on March 31st. Thus, we will not see any of the impact of the first rate cut in these numbers. Perhaps Q2, though more realistically Q3, as it does take time for a reduced prime rate to filter into the data. Since we are about to jump into the data, we are going to need to call on that guy who only eats the numbers in his SpaghettiOs, the one and only Mr. Math. As usual, we will begin with a little surface data. Their current value at the time of recording was $16.40. They have a market cap of $2.15 billion and a beta just a little more volatile than the market average, coming in at 1.20. Their earnings per share, not nice. It is negative 3.73. This does make them currently unprofitable. However, I do need to point out that over their last 5-year average, they've been profitable on that average. Normally, we would tell you about the price to earnings ratio at this point, but price to earnings is not really a great statistic for a REIT. So we are instead going to look at their funds from operation, or FFO. In a nutshell, the FFO is a measure used to define the cash-generated operations. It is calculated by adding depreciation and amortization to earnings and subtracting any gains on sales of properties. It is considered more accurate than a PE ratio for real estate companies because real estate depreciation often distorts true operating performance. So their FFO is coming in at $2.26 per share, and they are projecting that to go up to $2.27 in 2025. Their price-to-book ratio, that comes in at 0.40. The average amongst their peers is 2.0. Let's look at that return on equity. That comes in at negative 8.13%. I don't like a negative, but once they do get back into profitability, that number will flip back over to the positive side. Their return on assets, that comes in at 1.56%. Considering that wild ride our Canadian REITs have been on for the last few years, this surface data is not too bad. It, of course, will look better once they move back into profitability. Okay, now that we have trodden along the surface, let's peel back another layer and take a gander at their overall cash situation. They have a revenue of $572.67 million, and those earnings, yeah, we were expecting a negative $535 million. Now, here's the good part though. Their projected earnings growth is 95.79% per year. This will definitely help them get back above water. Their profit margin, once again, we're still in the negatives, negative 93.4%. Their free cash flow actually looks much better at $294.14 million, And their operating cash flow, $294.17 million. Let's look at their fair value. So their current value, once again, $16.40. Using a discounted cash flow model, we get a fair value of $32.86. That does peg them as being undervalued by a whopping 50.9%. I'm expecting a pretty good projection here. So that 1 year projection, that's actually coming in at $19.67. So that's a 16.4% rise expected over the next year. I am really liking where the future projections are pointing to. And if the analysts are right, this could be an interesting REIT for sure. Okay, it is time to dig a little deeper and take a look at their returns data. They have a yield of 11.173%. It is a monthly dividend, by the way, of 15 cents per share. Their payout ratio, it is skewed from some of that data, so take it with a grain of salt, 398.95%. That payout ratio, yeah, it certainly does make it look unsustainable. However, they do have pretty good cash movement in their free cash flow, so they can certainly sustain that. And I have a feeling once we start seeing those earnings pump back up, that payout ratio will come down quite a bit. Now, their 5-year average dividend increase, that does work out to 2.56%. Switching over to return on investment, for the 3-year, their price fell from $44.87 down to $16.40. That is a dismal return on investment of negative 63.45%. Even their dividends don't save them or even help them very much. Negative 50.91% for the total return. On their 1 year, their price fell from $23.12 to $16.40. So that's a return on investment of negative 29.07%. Adding in those dividends, we get a total return of negative 19.20%. On the year to date, not a lot happening. Their return on investment is negative 18.57%. Factoring in the dividends, we get a total return of negative 11.72%. These are absolutely numbers that are hard to love. The only saving point here is that we do know there's going to be a lot more cash flow in the future. And that should really hopefully get these back into the positive. But for now, these numbers will scare a lot of you off, no doubt. Okay, let's dive one last time down into that debt data and see how they did there. So they have a total debt of $3.72 billion. This is a lot of debt. But in all fairness, they owe just shy of $4.5 billion just a year ago. So they are currently working on lowering it. I have a feeling if they hadn't been lowering that debt over the last year, their situation wouldn't be as rosy as it is so far. And we're not even talking a very red rose at all. Their total equity, that comes in at $6.06 billion. So their debt to equity ratio, 61.4%. Normally we like to look back over the last 5 years. And if we do that, that debt to equity ratio has increased. It was 40.2% just 5 years ago. However, when we look just 1 year ago, it was 65.4%. So on the 1 year scale, they are definitely moving in the right direction. As far as cash and cash equivalents, not a lot of excitement here, $12.99 million. But let's look at the short term. They have assets of $540.31 million and liabilities of $809.92 million. Definitely not ideal. Moving to the long term, they have assets of $9.94 billion and their liabilities $3.61 billion. So a little bit of a better picture on their long term. So you gotta like that at least. When it comes to this debt situation, we've seen a debt on the decrease, which is great. Though currently they do not have the cash flow to cover the debt itself. But they do have the cash to service it just fine. Honestly, this debt situation it's not as bad as I had feared going in. And there are signs that the debt is a priority for them, and I do like that for sure. Okay, I do think we have enough information to pose that one last question. What is my final verdict? REITs have all suffered in the last few years, thanks to the aggressive rate hikes to combat inflation. REITs that cater to office properties had, of course, the additional burden of lockdowns and work from home, as well as a transition by many companies into that hybrid work model. AP REIT falls into the latter camp, and they've had to endure both. That should slow their recovery, but after looking at these numbers, I do have to ponder if that is indeed the case. They are poised to start doing much better in the coming year, and with a healthy dividend, it sure does make them look like a solid bet. For the passive income investor, this is a good entry point, as they should begin to transition to a more upward stock price trend sooner than later. And that dividend, it's not too shabby as you ride it up. Now, that growth with that dividend does make this an interesting REIT for the total return investor. This one may not grow as fast as some other REITs, but that nice looking dividend could just give them the edge when it comes to racking up those total return numbers. For the pure growth investor, you will more than likely not be impressed with the growth side of this REIT, and for that reason, it may just be one you skip while getting your diversification another way. No matter how you approach it, the only certainty with this REIT is that the next year will tell a completely different story than the last few years. If you are interested in Allied Properties, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on CT REIT. Thank you for watching, and I will see you in the next video.